Welcome to the stock play of the day. Today's stock is Home Depot, symbol is HD. We'll discuss, should we pass or should we play? Hello everyone, my name is Brian Overby. I am the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist at Ally Invest.
All right, Lindsey. Well, I'm looking at the S&P 500 index chart, and a lot of people have been making jokes that it's kind of scary to look at a chart on anything. But I'm going to actually say this is no longer a joke. We look at the S&P 500 index, and you can see it here. See my chart from the Ally Invest platform. And we've broken through a trend line, a fairly important one over the last week. We mentioned it. We've been mentioning it actually quite often over the last few weeks on the stock play of the day. But if you look here, you look at the bullish trend line that was set all the way back in March of 2009. We've never came back to that low point as far as the overall market. But if you just follow the trend line, and I don't know if I have it drawn exactly here, but bottom line is you can maybe touch this point here, but it's definitely broken through that to the downside. So that bullish trend has finally been broken from 2009.
Yeah, Brian, that's it is scary territory we're in. At the end of last week, the S&P 500 closed down 32% from its February 19th high. So we're beyond bear market territory here, and it can be a very stressful place to be, especially when you're seeing the type of volatility in the market that we've seen. You and I talk about the VIX all the time, and we've seen 5% moves from the high of the day to the low of the day over the past couple weeks now, and that's not something for the faint of heart for sure. But today we saw a little bit of choppiness in the first couple of hours of trading, but now it looks like both the Dow and the S&P 500 are decidedly moving lower to the lows of the day, reaching new low levels here just in time, by the way, as the Senate is reconvening at noon today here to revisit the fiscal stimulus bill that they voted on last night. It was a procedural vote. It failed. Investors are really looking for the Senate to get something through to really begin the process of getting this fiscal stimulus package on the president's desk, signed and into effect, to get money into the hands of individuals that need it the most and the small businesses that need it the most right now. So that was leading the choppiness this morning, but the Fed swooped in before markets opened. Once again, it's been a trend that we've seen for the last 3 weeks, and they just pulled out all of the stops just when people started whispering about them not having enough ammo. They're out of ammo once they went to 0% on the interest rates. But this is the biggest move. All of the things that the Fed has done over the course of the last 3 weeks is it really shows the support the Fed does have for the markets and ensuring that they operate in the most efficient manner as possible. So the Fed is doing their part. We now need our elected representatives to do their part at Congress and in Washington, D.C. to really get that fiscal stimulus package across the finish line to really help those that are struggling the most in this period of time. So that's what's really kind of driving market action today. Obviously, we're looking forward to the end of the week. We're going to get another read on fourth quarter GDP. We're going to get jobless claims, which many are expecting a massive spike in this week from last week. We saw a bigger jump last week to 280,000 people looking for jobless claim benefits. Goldman Sachs, I think it was, is out there last week saying that could top 2 million this week. The economy is shutting down. If you think about California and New York, they are the two largest economies in this country, and effectively both of these states are not officially in a shelter in place mode, but pretty close to it. Most things are shut down. I'm here in New York City, and I can tell you it's pretty quiet out there on the streets. Anyway, we hope that all of our viewers are being safe, though, and then also thinking reasonably as we go through these crazy times in the markets. And so, Brian, I know we have about a week left on the trade that we talked about last week, which was Exxon Mobil, your options trade, which, by the way, we like to look at options, especially in volatile times like this, as a way to invest the money, especially if you have some free cash on the sidelines, given the amount of uncertainty that's out there. And some of the trades that you've put together, Brian, have really taken that into consideration. So where are we at with Exxon?
Well, I had the chart up on the Ally platform once again of Exxon this time around. And it is, last week we kind of billed it as a FOMO situation as far as the markets are concerned, fear of missing out. A lot of people might have some cash on the sidelines. If you don't, that's also a lot of people are just staying still and investing for the long term if you can. But if you did have some cash on the sidelines, how could we make that work for you? And so hence we titled it FOMO, which was very similar to our digital conference that we actually just did last week. And if you look at the FOMO situation in Exxon Mobil, we were selling a put saying that, well, oil was at $36 a barrel. If the stock does come down to a certain level, maybe we'd be interested in investing some cash in the marketplace. And the reason why I have the chart up here is I'm showing you it has came down. The stock was at 36. Now it's down to 30.82. Now that's a live quote on a live streaming platform. But we look back, we had to go all the way back to 2002 on this chart. I basically can't get the chart on the screen to show when the last time Exxon Mobil was down around these levels. So last week we sold a 32 strike put. That put we sold for $1.50. That meant that if you were truly intending to buy the stock, and we'd find that out now because that's basically how we build it, as a cash secured put, we'd say, well, if the stock comes down to that level, and now oil went from 36 a barrel to, I saw a delayed quote on it this morning, down around $22 a barrel, that same barrel of crude oil, and the market has reflected that. So the stock came down from 36 all the way down to 30.76 right now. We sold a 32 strike put. We brought in $1.50 on that put. On a relative basis, your cash that you would have had to put up is $3,200. That $1.50 would have represented $150. You were looking at over 4% brought in for just saying, I'll buy the stock if it does go lower. So now it's at 32. And as a matter of fact, here's what's interesting, Lindsey, overall, is that we're still buying it lower than the market, right? Because we sold the 32 strike put. We received $1.50 for that put. And that $1.50 means that our cost basis on this would be $30.50 in this instance. And with the stock a little bit higher than that, we're actually buying the stock lower than the current marketplace. Now, who knows what's going to happen? We have one more week left. And as a matter of fact, we might want to think about just buying the stock here in this instance, in that if you really want it at 32, our biggest concern here is that the actual marketplace comes back and finishes above 32 at the expiration, and you actually don't end up buying the other underlying stock. But so the theme is going to stay here. The FOMO theme is going to stay. We're going to look at fear of missing out. What are ways that we could interject money into the marketplace and get paid now for saying we'll buy if the market continues on down, and how we can slowly put money into the marketplace overall. All right. So stock of the day, Home Depot.
Yeah, thanks, Brian, for reviewing Exxon there. But yeah, FOMO is the theme. And Home Depot is a stock that just last week alone, in 1 week, 5 trading days, was down 26%. It's a huge move in 1 week. It's down 38% since its 52-week high, which was on February 20th, so a day after the market topped. Looking at valuation of Home Depot, it's trading at 14.7 times on a forward PE basis. It's gotten taken down with the rest of the retail landscape. Many retailers are closing stores to protect not only their employees but customers as well, while different cities start to shut down. So the retail landscape has been hit pretty hard, unless you're Walmart or an Amazon or a grocery store that's selling the things that people want right now. But Home Depot actually is one of those types of retailers, if you think about it. Now, of course, when you think of Home Depot, you're thinking, okay, people are stuck in their homes. Are they really going to be doing do-it-yourself projects on their homes? They might. I mean, if there's not anything else to do, why not work on those things, those different projects that you've been putting off? But more importantly, they're like more. My point is that they're more like an Amazon and a Walmart than you think, because they sell cleaning supplies, and usually, sometimes I buy my cleaning supplies there because they're cheaper than buying them at other places, at least in the New York City area. But also, they sell things like refrigerators and hot water heaters and electrical and plumbing equipment too that you might need in a time like this. So the products that they're selling are in high demand, and they might be easier to find at their stores versus other stores. So that's kind of one reason we wanted to look at it. Now, they did say they're not completely immune. They are reducing their hours that their stores are opening, but they're also supporting their employees by expanding their paid time off policies too. So that's a nice little benefit that they're giving their employees that may get sick or feel that they need to stay away from the stores. Home Depot also has a big online presence. So online sales last year grew over 21%. That's a pretty good clip, which also makes it more attractive. And they've just recently started investing in their home delivery services. They're seeing some really great success with their appliances. So they may, who knows, they haven't mentioned this yet, but if we could see them step up investment in that, that could help them at least in the near term, where people are looking for things to be delivered to them instead of going out to get the products that they need. But anyway, we just think this is a stock that, from a fundamental perspective, it's down 38% from its recent highs. They last reported earnings on February 25th, which was only a couple weeks ago. I went through the transcript. I went through the press release. There was not one mention of coronavirus at that time. Obviously, the situation has changed significantly in the last couple of weeks. They haven't come out and announced that they're, suspending guidance or withdrawing it like several other companies, like a Best Buy has done, for example, within the retail space. And of course, they may have to reduce the guidance that they provided just a couple of weeks ago, given how dramatically things have changed over that course of time. But regardless, this is it's a high quality company. They do have some debt on the books, over $30 billion, but they also have really strong cash flows that are expected to increase by 10% into the next year. They do pay a dividend right now, which is yielding 4%, which looks pretty good in this market. Another kind of indicator that the stock might be cheap. Also, the other thing is they have been buying back shares. So if they were a little bit concerned about their cash flow situation, again, I don't think there's anything to be concerned about. They could obviously stop buying back their stock and save a little bit of money. But this is just one of those high quality names that's gotten really beat up in this market environment. It's got thrown in to the mix with other retailers that might, offer apparel or other things where their stores are closing. These guys are staying open. They offer essential goods. They do it online. They deliver it to their home. The biggest knock against these guys is guidance could be taken down given the rapidly changing environment. And then also, I got to call out the 46% of their sales come from the pro customer, which is, your small businesses that are contractors or, they're fixing floors or ceilings and whatnot. That business probably is going to take a hit in the near term, given everything that's going on. but otherwise they do have some of the goods that people need. So Brian, from an options perspective, if you're not too comfortable with the fundamentals to actually buy the stock outright at these discounted valuations, how could you look at it from an options play?
Well, we're going to keep the theme, the FOMO market and fear of missing out. I want to get some money working for me here. Well, last week we looked at a cash secured put. Now we're going to look at the same version of that. Now, a big difference between last week and this week is that if you look in the chart here, first of all, Home Depot actually has a green candle today, right now. We're actually up 1% with the markets in general down 4% across the board. So we are actually seeing a little bit of positivity in the marketplace. But if I'm looking at Home Depot, it's a $156 stock. So it's a more expensive stock than Exxon Mobil. At one point in time, Exxon Mobil might have been up in that range. But at this point in time, Exxon Mobil is trading at $32. And I say that because if you're looking at it on a cash secured basis, and last week we sold the 32 strike put, that means for every put, you got to be willing to buy 100 shares of stock. So on a cash secured basis, you would have to have $3,200 in your account. Could be done in a retirement account, any other type of account with your brokerage firm. If you do that, that's a much lower requirement than doing it on a $150 stock, right? So you're talking about $15,000 to say, well, I will buy it. And that's the plan here. We're trying to look at kind of bottom fishing, get your capital to work for you, and if the market comes down, we'll buy a little bit now, and that's the plan. We're not going to buy, if you wanted to buy 300 shares of Home Depot, I'm going to look at buying 100 now, not buying all 300. We're going to try to pick our spots. And the way that we're going to do it this week is we're going to actually do a short put spread. Now, the difference between a short put spread and a cash secured put, and there's one big difference, is that you're going to use some of the capital that you receive from selling the put to buy some protection. And we're going to do that because we have an expensive underlying that could have some downside still. So we're going to protect ourselves on that downside. We're going to sell one put at a higher level, saying this is a spot that we wouldn't mind buying it. And then we're going to buy another put at a lower level that's going to give us some protection overall. And inside the Ally Invest Options playbook, we see the short spread here. This paints a picture for us at expiration what our risk reward is. We're selling strike B, that's where all our risk is coming in. We're protecting with strike A, which is lower below the market. The stock is somewhere up in this level, above where strike B is currently at. All right, so let's run to the Ally Invest chains. Let's look a little bit at Home Depot. Now, Home Depot's not expected to announce earnings until May 19th. That's the date that's an anticipated date, a little bit farther out, so we're not exact on that. And they also do pay a decent dividend. It's about a 4% yield, which in this marketplace, considering the big downturn, that's not a huge dividend, but they do pay one. And they don't, at this point, we don't see any indications that they're going to be cutting it at this point, I do emphasize, but it's $1.50 a quarter here when you look at this trade. Okay, and now, oh wow, Home Depot all of a sudden just jumped amazingly. Somebody must be listening to our call, I guess, Lindsey, at this point in time. But Home Depot literally just was up $1. Now
What I saw a headline come across, but continue. Sorry to interrupt.
Yeah, because it was down. It was up 1%. Now it's up 4%. Okay, so that's the thing about doing it with a live trading platform. It's going to adjust our trade a little bit too. So when I'm looking at these trades, I want to look at the expected move. And the options marketplace has its challenges just like the stock marketplace does. And one of the biggest things is understanding that the implied volatilities in Home Depot, and we're trading in a month that does not have earnings. And if I just look at we're going to go out 25 days to the April 17th expiration, the most at-the-money option contract, just to get a feel for implied, is trading at about a 76% implied volatility. Home Depot doesn't even usually trade at that level normally when the earnings are going to be announced. That would be considered high even if there was earnings. So just to let you know what the volatility expectations are, they're not going to be announcing until May. This is an April 17th expiration. We're going out 25 days. So what do I like to do? I want to look at the most at-the-money straddle approximately just to get a feel for where the marketplace is at. Nobody, when you tell somebody it's a 76% implied volatility, unless you really put a number behind that, it's hard to say, well, what does that really mean as far as the movement is concerned? And the way the pros look at the marketplace is the stock's at 157 right now. It's moving quick, almost 158. Let's take the 160s, just kind of look at the midpoints of it. We'll call it 13. We'll call this one 11. So you're looking at about a 24-point move to the downside in Home Depot. That's well, I shouldn't say downside. In other words, it's a 24-point move without regard to direction. But if you look at buying a put and buying a call at the most at-the-money strike price, it gives you some indication of what the marketplace thinks this underlying stock can move by that April 25th expiration. So if I'm selling this and I want to try to bottom fish, what I want to do is be beyond that price. So we said about 23, 24 points. So right now the market has moved. So obviously my strikes are going to be a little bit different. But I started out at the 120 strike, and it still looks like that's a feasible trade. 120 with the stock at 160. So we're 40 points away. So we're more than what the marketplace is anticipating. And if I look at the bid ask, we're still getting a ton of premium for that. You know, you're looking at the 120 strike saying I would buy 100 shares of Home Depot at 120. That'd be $12,000 if I was put that stock at that price. Now I'm going to buy some protection. I'm going to use some of that credit to buy the 115 strike put. And if we look at that right now, we're seeing, yeah, it was a little bit higher when we started. Obviously, the market just went up 4% basically since the start of the call. This was a dollar trade. Now it's at 54 cents. So let's adjust on the fly. I would probably go up to the 125, and then we're looking at 70 cents, 1/3. All right, so we're going to keep that theme. My thing's going to be a little bit off, but I'm going to adjust on the fly here. This is what we got to do here in the options, especially in this market condition. All right, so if I'm 30, I'm still more than 25 points away, and I'm just doing quick math. I'm looking at the asking price at 130 and the asking price at 125. In other words, I'm going ask to ask, which kind of accounts for bid-ask spreads a little bit, and we're about $1. So if we go and look at the midpoint from 495 on down, so now we're at a 70-cent net credit, and I feel a little bit more comfortable at that. I'd like to bring in a little bit more cash, so that's going to be our net credit to the account. Now, if Home Depot doesn't come down, the maximum we can make is, and I'm going to call it 75 cents. That's going to be our paper trade for this week. 75 cents. We're 5 points wide. The maximum we can make is 75 cents. The maximum we can lose is the width of the spread, which is 5 points, minus that net credit received, or $4.25. So if I scroll down, I'm going to have to regraph our profit and loss calculator here. And we'll zoom in a little bit. So this is where Home Depot stock's at, 157 approximately. That's where the stock is at. This is where our risk starts at, 130 in this situation. 130 to 135, we have risk, and then from 125 on down, our risk is capped on this particular position. Now, if you cap that risk and you still want to buy the stock, well, you can. You can just close out your long spread or your short spread and buy to close it, and then, you know, buy the stock at the lower price if you wanted to. But we're ensuring that if it does go down more, almost double the expected move of about 24 points, right, that we would have some protection in the marketplace by the way that we set up the trade. All right, so my actual trade screen is going to be a little bit different. So let's just look at it this way. Home Depot, I'll move up to here. Let's do it right off of here. So recap our trade. We're going to go out to the April 17th expiration. That's the normal monthly expiration, and I'll talk a little bit about that, in the summary, why I picked this expiration that I did. We're going to sell the 130 strike put, which is about, I guess it's 37 points below where the current marketplace is at. We're going to buy some protection with it, the 125 strike. We're doing this as a FOMO trade, fear of missing out. That's part of the reason why we're doing it. We're putting our capital to work for us. We're trying to cherry pick some stocks that we wouldn't mind owning at lower prices. We did it last week using a cash secured put. This week, the trade that we're going to look at is a short put spread. Main reason why we're doing this is because Home Depot is a higher price stock than Exxon Mobil. It's that simple. So because of that, we're gonna reduce our risk to the downside if the stock does come down. But ultimately, our goal here is to buy the stock at that price. That would be the ideal situation if you're doing this short put spread with the idea that we want to buy Home Depot at lower prices than where it's currently trading. All right. So I guess it's time to get to our listener questions. Let's see if we have a few out here, Lindsey. All right. Yeah, we do got quite a few that are rolling in here. So Charles, we'll start with Charles. The more states have used executive powers to do state lockdowns today. I guess that's more of a statement in this situation. What about state lockdowns? It's happening, huh, Lindsey? I guess we'll just kind of, what have you heard?
Yeah, I mean, it's definitely happening. California being the biggest state to do it. And, obviously, Governor Cuomo here in New York also asking people, all 100% of non-essential workers to stay at home. So, yeah, it's a big trend we're seeing. It's going to have a major impact on the economy, which is why we need a fiscal stimulus bill to be passed ASAP to get that money into the hands of the people that need it the most.
All right. And then this one comes right back to you, too. And it's a great question. Why did you choose Home Depot over Lowe's?
Yeah, that is a really good question because Lowe's has been beat up even more than Home Depot. I think it's down 48% from its recent high, where, like I said earlier, Home Depot is down 38%. The difference between the two is really that Home Depot's a little higher quality. They have less debt, better cash flow than Lowe's. So that's kind of why we wanted to look at that. The flip side, though, is that Lowe's does have a smaller percentage of that pro customer. So about 20 to 25% of their sales come from that professional construction worker type of customer. Whereas, like I said before, 46% of Home Depot's too. So there's a little give and take, but we just like the debt situation and cash flow situation on Home Depot better.
Well, and I'm just going to toss in here. I'll tell you, this weekend I was at Lowe's, not Home Depot, but obviously in the same world, and it was even hard to park. I think a lot of people are out thinking, well, I'm going to be home for the next month. Let's start looking at some projects, and there might not be an opportunity. And Charles is putting out that Michigan and Massachusetts are closing down, and some places will. So ultimately, if the stay at home rule comes through, maybe that's where we end up. But right now, I see big demand in that area.
Absolutely.
So, okay, last one. It looks like it's for me. Looking at the options chain, the spread between the bid and ask is quite wide. How would you combat that? That actually is a good point, and I wanted to mention that a little bit while we were talking on your call, so I'm actually glad that someone brought that up. If you're looking at wider bid-ask spreads because of volatility, first of all, let's explain what the question is. The bid price is, if I go to the marketplace and I sell this option right now, that's what I would receive. It's called the bid. The ask price is what I would receive if I bought. If I put it in order to buy in the marketplace, that's what I would pay. Now, when markets get volatile, a lot of times that spread will widen. It will become wider, which means overall costs of trading go up a little bit. And because of that, doing spreads will sometimes help that situation. Today, we talked about a short put spread as opposed to just selling a cash secured put. And we had a more expensive underlying. So that also means the option contracts would be more expensive. And when you come to the marketplace with a buy order and a sell order at the same time, a lot of times you can work the order a little bit better and get a little bit better fills. Why? Because you're giving the market maker that's trading with you, in theory, right? That's who you're trading with down on the trading floor. You're giving them them a hedged position already. And a lot of times because of that, you can fill a little bit closer to the midpoint. We always look at the midpoint, and that's what we did on our trade today. It's never a guaranteed fill at that price. But if markets are more volatile, I'd be more apt to do spreads as opposed to buying options outright because of that implied volatility. All right, I do have one more here. Now this brings up a stock that we talked about before. Hi, where do you see Costco in the near future? And is it the right time to invest in Costco? We actually talked about Costco, I don't know, about 3 or 4 weeks ago here on the Stock Play of the Day. Any thoughts, Lindsey?
Yeah, we have, and it's done pretty well since then. It has since reported earnings. I'm pulling it up on my screen here. Let me see where it is. It's actually down 2% today. It's been a volatile stock, but I think this is one of the companies that also benefits from the near-term trend of people wanting to buy essential goods. And, there's been plenty of, pictures on social media and different things like that showing how Costco's shelves have emptied out pretty quickly. So they'll be one of the beneficiaries, at least in the near term, of this new normal that we're living in, working from home, and states asking people to stay in as much as possible to prevent the spread. We still think Costco looks good. I don't think we have time today to look at the options chain that we pulled up back then to see if we can do a new one today, but maybe we'll look at that in the weeks ahead.
All right. Well, then let's do a real quick summary. We're getting a little long in the tooth here, but let's talk a little bit about the markets. SPX, big day breaking through well, I should say big week breaking through the trend line there set down in 2009. Any other thoughts?
Yeah, it's, there's a lot of people out there projecting a little more downside from here, but we're always looking for opportunities in the market for short-term trades through options with Brian. And then also just if you're a longer-term trader, this too shall pass. We've been paid, we've been rewarded to be long-term investors.
All right, and then I'm looking at Home Depot. It made a bounce since we started the call. We're now it's really volatile. Well, I guess it's kind of an oxymoron to say that nowadays, really volatile, because just overall everything is. Up 2.6% right now. Trying to watch a live quote streaming here. It's up $4 since the beginning of the call here. Home Depot overall.
Home Depot could be another beneficiary of the current environment. And, it's a high quality company with solid cash flows. So, over the longer term, I think you can't go wrong.
And a few people have now mentioned inside the chat box here, a few people have mentioned that, places are closing down, but Home Depot has definitely set itself in the internet space too. And you're talking about the home deliveries, even things like refrigerator nowadays. Not 100% sure what's going to happen with home deliveries overall, but they've positioned themselves well as an internet company alongside their storefront. All right.
Yeah, they're investing in that, in the home delivery. So we'll see. Right. Hopefully they can speed up that process. And
I definitely beat up the option strategy. I talked a lot about it today. We're going to highlight these last 2 weeks as FOMO, fear of missing out strategies, trying to cherry pick bottoms in companies that might make sense in the long term. So that's it for the Stock Play of the Day. Please make sure you click subscribe and you hit the bell so that you get all of the alerts. And we'll see you same time, same place next week.
Yep. See you next week.